Today is Tuesday, May 13th, 2014, and welcome to this week's Money and Markets Talk Call. This is George Lambert sitting in for Mike Bernick. Today, our editors will discuss the euro, emerging markets, bond markets, and where to find the next great opportunity. With me today are Mike Larson and Mandeep Ray. Okay, let's start with Mike Larson. Mike, for the past couple of months, you've been saying that the euro currency was vulnerable. Can you give us an update on that?
Sure. I think one of the most interesting developments in the markets that I follow is indeed what's going on in the euro exchange rate, and that also is tangential to what's going on in the interest rate markets. The euro currency has been steadily appreciating for month in, month out, despite the eurozone economy having worse economic fundamentals than the U.S., as well as lower interest rates overall. Essentially, money had been flowing to the eurozone as a result of investors chasing yield in peripheral bonds, buying up Spanish, Italian debt, and so on, because it offers higher yields, and selling their currencies and buying the euro to allow those transactions to happen. But I believe that process finally has gotten to the point where the European economy can't handle that strong of a currency vis-a-vis the U.S. dollar. U.S. economic data has generally been better than what's coming out of Europe on top of that. And now the ECB has finally kind of drawn a line in the sand and said enough is enough. President Mario Draghi at their most recent meeting basically said in the post-meeting press conference that, we're going to start doing extraordinary measures at our June meeting, barring some huge change in circumstances. So what that means is that as of the June meeting, the European Central Bank will either be openly printing money per a Euro QE program, or they'll try negative deposit rates, which basically would punish European banks that put money on deposit at the central bank. They would have to pay for the privilege of doing so. There are some other things they're talking about, some other long-term lending operations where they give free cheap money to the banks to lend out. Any and all of these things could basically are designed to reinvigorate inflation in the eurozone and cheapen the currency. So we saw a dramatic intraday reversal on the euro currency the other day, the day the meeting came out, and the euro has continued to sell off since then. We went from about 140 against the dollar, meaning each euro was buying about $1.40 US cents, down to about 137 today. So that's a loss of 3 cents is a pretty big move in the currency markets, and we've broken a uptrend line that dates back to last summer. So I think what's likely to happen is the euro continues to weaken from here as they take the reins. The U.S. Fed will continue to tighten by getting rid of QE here and then eventually raising interest rates, whereas the eurozone and the European Central Bank is behind us in that process. So I expect the euro currency to fall against the dollar. I have very large short positions in the euro via EUO, which is a double short euro ETF. That's both in safe money and in interest rate speculator, and I think that's the kind of slower moving position. I mean, even again, when currencies move, they don't move in huge gaps or huge chunks like you might see with a stock, for example, a volatile stock. But I do think that's going to be a good money maker over time, and it's starting to come in line this week. So that's probably the most noteworthy development I see.
Okay, well, while we're on the subject of global investing, you wrote in your afternoon Money and Markets yesterday that about the emerging markets. Do you foresee more crisis there, or do you foresee some opportunities in all this turmoil?
Sure. I mean, the emerging markets through most of last year and then early this year, we're just getting absolutely hammered on news of a Chinese slowdown, economic slowdown. The real estate market, there's a lot of talk of bursting bubbles over in the Chinese real estate market and so on. So that dragged down the entire emerging market complex. And then, of course, we had Russia rattling its saber in the Ukraine. We had Argentina devalue its currency last year. We had the Turkish lira plunge after Turkey. People were pulling money out of Turkey, and they had to raise interest rates by 400 basis points overnight and all that. That really caused emerging market equities, currencies, bonds to collapse in value. But to the point where emerging market stocks and assets relative to the value of stocks and assets in the U.S. and other developed markets has really gotten way out of whack. I mean, these are some of the most attractive valuations for emerging markets going back almost a decade. You saw starting in March and in April, some of the emerging markets have actually stabilized and started going up, like the ETFs that track the emerging markets. If you put up EEM, M as in Mike, on there, you'll see that those kind of bottomed out earlier this year, and they've been sort of steadily rising here. despite what's going on in Russia, despite what has previously happened in some of those other emerging markets, and despite the ongoing Chinese turmoil, I mean, even as the Chinese news has gotten no better on the fundamental front, something like the FXI, which is the Chinese ETF, it's basically holding its own, and it's not at its yearly low. It's actually been trying to improve a little bit. So, it may all be priced in at this point. It may be that just these ETFs or these assets are just too cheap. But and within that, you can also find some diamonds in the rough. India, for example, Indian shares, the Indian currency, are soaring, even as other emerging markets have been kind of languishing, because there's a new political party that looks like they're going to take control of the Indian Parliament, and they're expected to usher in financially friendly, investor-friendly economic reforms that'll help tame inflation, improve foreign investment, and so on. So India has been sort of a diamond in the rough. Long story short, for a while, I didn't want anything to do with emerging markets pretty much anywhere, but I'm starting to warm to some of them, and I think we're seeing some potentially encouraging action there outside of those that are directly impacted by, Russia and so on.
Okay, well, what's a good ETF for our listeners to consider for investing in India?
Well, again, for India, you have a couple ETFs that trade under the ticker symbol EPI or PIN. Those are two of the ones that are out there that track that market. And there's also some individual Indian equities that have ADRs, American Depository Receipts, that trade here on U.S. markets. Basically, that's just a U.S. tracking stock for what the Indian stocks are doing in their home market. Something like IBN is one of those. It's one of the largest banks in India, and you can buy that right on the New York Stock Exchange. So those are the kinds of things you might want to look at as a way to play that.
Okay, great. Mike, thanks a lot.
Thank you.
And Mandeep, what do you and your team in the research department see for the rest of this week?
Hey, good morning, everyone. My thesis converges pretty well with what Mike has already said. There's, the markets here, the data here in the U.S. is looking okay. Retail sales this morning was a bit of a disappointment, still showing growth. However, the markets are kind of fickle now. It seems like we're coming towards the end of a secular bull market rally, and it's kind of making investors a little bit more choosier in their investments. They're substituting value for growth, and that sort of thing is happening. We're going to get some crucial data out this week. This has all been supported by the Fed, so we're going to get some inflation data from the Producer Price Index, the CPI, and some sentiment indicators this week. That will probably help investors foreshadow what the tone of the Fed is going to be in terms of interest rate hikes in the future, and that's going to fuel a lot of what goes into the stock market. We do like Europe here. We think that the U.S. led into this recession and consequently led out of the recession with the extraordinary Fed stimulus packages that were introduced, and the rest of the world kind of followed in and is kind of struggling to some degree. Stabilizing would probably be a better way of describing Europe in particular. They haven't caught up to the rally the U.S. has seen, so there is opportunity there. And if you have a weaker currency there, which is as Mike was saying, the ECB, Mario Draghi has been foreshadowing, that could be positive for the exporters there. German zoo survey came in for current business conditions better than expected. Future anticipation was worse than expected. So a bit of a mixed result there. We're trying to play the equity markets in Europe through the angle that Mike was speaking to, buying U.S. ADRs that have exposure to diversified geographies, including Europe. One of our stocks is FRM, Fermanite Corp, which has half of its revenue to the U.S. energy industry, whereas it has about a third and the remainder to Europe and Asia, respectively. That's paid off pretty favorably for us because we're trying to look forward. We see an aging bull market here. Where is the next equity returns going to be for us? And like Mike was saying, the credit markets aren't giving us what we'd expect in terms of yield. We see Europe, the Spanish bonds, Italian bonds, coming way off their high yields. Those bond markets are probably not going to have the attractive returns that you want. Equities is the way to be. We do like India as Mike was also saying, China is kind of it's kind of a riskier place to be because of the housing bubble. We have growth slowing down, but housing, which is a huge component of their yearly production, is heavily levered. And people aren't buying the houses as fast as they used to be. So the developers are taking sometimes 15-20% cuts on their prices, and they still have to finance the same amount of debt. The government has continuously said that they're going to support these banks, they're going to recapitalize them, but that could be something, it could be more pandemic, and if that happens, that could be instrumental in bringing down global equities. But we're watching for that. It's not there yet. But we're continuing to focus on where we see the value here for our portfolio.
Okay, excellent. From Money and Markets, this is George Lambert. Please join us again next week for another discussion on stocks, currencies, precious metals, and global investing. Have a good day.